Hey, hello folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is our options guide to cracking the code on trading options. I'm going to start with simple concepts and build the real life examples throughout this video. So please don't hesitate to stop me in the comment section over there. If I'm not being clear, throw it over there. Hey, Wolfman, I want a little bit more clarification. I'll drill down on that for you. So do not hesitate to comment over there on the sides. All right. And don't forget to smash that like button for me. If you want daily market commentary, hit the subscribe button. Right next to it's a little bell. I don't always announce them. We kind of have a scheduled time. It's going to be before 11 o'clock, but that's not necessarily on the dot. I could pop in unannounced. So make sure you subscribe and hit the bell next to it, folks. All right, let's get on with the options guide to trading options. We are going to be doing this on the poor man's covered call. And really what this is it's a synthetic long, similar to what we've done before, but what we're going to do is create a defined risk strategy with this. So just like with a stock that we would own, really it's like throwing a collar around it, not just covered calls. The beauty in this strategy is there's limited risk to the downside. If you own the stock, you don't have limited risk to the downside with a covered call strategy. All you're really doing is lowering your overall cost basis. So this strategy, we're going to be able to limit that downside risk and still take advantage of upside potential. I'll show you how to do that with this specific strategy. You know, when I name these strategies, or when we would name these strategies on the floor, it was so that we could think about them very quickly. A lot of folks will be doing these as like diagonals this way, but when I do a diagonal, it's not usually in the money. Whereas with the poor man's covered call, we'll show you how that works out. But first, let's really start building from simple concepts to real life examples. As we know, data is transferred seamlessly from computer to computer. The data flows very quickly. Why? Because we've broken this down into the most simplistic way possible. And that is O's and ones to transfer data. That's the simplest form of like computer science, if you will. And I'm going to do the same thing for you guys when we're talking about options. I know when you go over to the option montage, it looks like this screen where there's just numbers flowing, and it's really hard to discern what's going on there. Like I said, we'll start with simple concepts, build to that real life example. By the time we're there, I think that you guys will have a solid understanding as to why these levers and pulleys are making a difference in the market, especially with options. Now, let's go to the real life example, or simple concepts, if you will, with the housing markets. Folks, we've seen in just the past few years, the housing markets do all kinds of crazy stuff. Generally speaking, in the past, we've talked about housing prices just go up in value, right? It's one of the best assets you can buy. But we've seen those housing prices go up and we've seen those prices go down. So not only are they always in flux, we really just don't know what the price is. If we were to buy a house in and around this area of the middle of the road, if you're going to buy this house, you do expect prices to go up, but that's not always the case. Sometimes prices go down. So when you bought a house for this, you might end up paying a little, or selling it for a little less. You know, in some cases you can sell it for more. So we don't necessarily know that housing markets are always going to go up, because we've seen just in the past couple of years, price rise and fall on these houses. So while folks are always talking about certain assets are a great investment, like similar to Ron, I'm glad you're here, Ron, because I do this all the freaking time, don't I? Seems like lately. So what we'll do is talk about starting over. How about that, Ron? We got it together. All right. Ron's telling me to show my screen. Thank you very much. I appreciate that. I even have a sticky note here saying share the screen, and I just totally blew that off. So now let's smash that like screen. All right. So when we're talking about options in the form of data, this is what I was talking about. This is what it's like when we go over there and look at our option montage sometimes, right? Is it just looks like there's numbers flashing all over the place, and it can be confusing. But what we're going to do is make it simple. And what we do is freeze frame it. And this is what it looks like with the O's and ones. And what I was talking about earlier is the housing market. Sometimes the housing markets go up and down. We don't always know whether or not we are buying that house at the low level. Housing prices generally rise, but we've seen where people have panicked. Even just before the pandemic, people were selling their houses for less than a year prior. And then in the last 6 months, they've seen those houses like go up 50%, at least in the areas that I'm talking about. So massive fluctuations in price, even in homes. So a lot of people say with homes, you're going to buy low, sell high, even in the stock market. They're just like buy low, sell high. It's that friggin' easy, right? You know, people would have been talking about that just recently, buy low. Well, we've seen market corrections happen, and that is even lower. So the only person that I've ever really heard say this correctly was Joe Terranova when he said buy high and sell higher. Well, that's really what it feels like when you're trading in the stock market. Why? Because we just don't know what real value is of a stock. Yeah, we can say that it's multiple forward earnings and stuff like that, but that's not a true gauge of what that stock is worth, because we're increasing it forward. What if their sales, they don't meet sales going forward? Then it's way less of a multiple, maybe a 5 multiple. Well, when we're talking multiples in back and forth, is it a 5 multiple, 10 multiple, 20 multiple? Well, that doesn't tell us anything. So while people are saying buy low, sell high, it's a very novel idea, but really, what does it mean? How do I know when it's low, when I'm buying low or selling high, right? I mean, if I were just to look at this, I keep jumping too far. If I were to look at this chart, right, of course, this is the buy low. Maybe this is the IPO day of like Facebook or something at $40. They're talking about Facebook today a lot. But anyway, so that's low. Do you buy there? Well, what if you missed the IPO and you got the rally up and then it pulls back, you buy. Now you're buying low, right? Well, it's not as low as it could be. Well, especially if you sold high, you sell there, right? But what if it rolled up, came back down, and then boom, you sold because you just don't want to ride it all the way out below IPO and all of that stuff. You would panic out. So, everybody says you buy low, sell high, but there really is no way to tell unless the market is always just trading neutral, right? And then we can kind of tell when it's trading high and low, only in a neutral market, maybe like IBM or something. But in something like Tesla or Facebook, some of these other ones, it's harder to tell where the highs and lows are going to be because those highs and lows continue to go higher and higher, right? We have higher highs and higher lows. So where does that low then come in? So it's always the conundrum as to whether or not you're buying high and selling low. And I want you to forget about all that, because at the end of the day, we can only adjust those things that we can physically take advantage of. So if the markets are fluctuating back and forth, or you're trying to figure out if Facebook is a good buy here or sell there, that is something that will never really be hammered out, because everybody has the difference of opinions there. So what I want you to do is kind of forget about that. You're going to be looking at this more in line with when I have an assumption, whether it's bullish, bearish, or market neutral, is how do I determine how to take advantage of that assumption, okay? And yeah, you might sit there and say, well, I've got a bullish assumption, so I want to go out and buy calls because that's a bullish trade. That's where everybody gets themselves into trouble when they first start trading options, is because they don't understand the levers and pulleys of what's going on with that pricing. So while it's a very novel idea with the buy low, sell high, some folks out there who are much better chartists than me would probably look at this chart here and say, listen, Wolfman, all you got to do is kind of try and find those support resistance levels. And then that's where you trade in line with, right? You trade when it comes back into the channel here. All right. That's what we're looking for, is for the trade to be inside of that. Now, like IBM does a very good job at this. And if you guys have watched the daily market commentaries or the spotting the trade videos where I talk about daily trades, IBM is one of the best market neutral trades to trade because you kind of see that sideways pattern and can line it up with Fibonacci's and stuff like that. Whereas with bullish moves, it's a little bit harder to discern where those support and resistances are. So we're going to do something like this and find with pricing of options that they actually give us a little bit of a tell as to whether or not they are cheap or expensive. So while I'm talking about the options now, not so much the stock, okay? We have an assumption with the stock, whether it's going to go higher or lower. We're not really looking at the value there for the stock. But if we have that assumption, a lot of people will say, well, maybe I'll wait for a pullback here in the stock and then I'll get in, right? Because you're beholden dollar for dollar on those type of moves. Where with stock or with options on the other side of the coin, we can at least discern whether or not these options are cheap for that underlying or if they're expensive for that underlying. So that is the determining factor as to whether or not we'll be buying or selling, right? Because we want to buy low, sell high. The only way we can tell if we are buying low or selling high is when we're trading options. And that's because volatility, it looks like this. It's sideways. It has a tendency to be a very market neutral, if you will, type of trading pattern because every underlying has its own volatility coefficient, if you will. So while we're talking about VIX and you hear the talking heads on TV talking about the VIX, that's an overall broader stroke or a broader gauge of the overall market's volatility. All right. I want to know as a trader what XYZ or ABC's volatility is right now, because that tells me if the options are expensive or cheap. So while volatility looks like this, let's go to a real life example just to show you how it does. It will have a tendency to have those spikes like we saw in the last one. But what we're trying to do is capture where it's trading most often. Yes, it will pierce out, and I'm a little bit more aggressive with these lines, so you could go a little bit further out. But what I'm trying to do is probably look at something along like this line here, just above that line, to try and hit as many of those and then kind of try and draw a line in there. So now we've kind of gotten our really down and dirty support and resistances, right? Once it hits that upper band, what does that mean? What does that tell me? If it comes up to this band, I know those prices are expensive. This is starting to come down. What is that telling me is happening to the prices in the options? I'm not even talking about the underlying right now, just the options prices. As this starts down ticking, all of the options are getting cheaper, even if the underlying doesn't move up or down 1 penny, okay? If it just stopped trading right there, we could see volatility, or not really if it stopped trading, but if it just kind of held right there between a penny or 2 ticks, we could see volatility coming out, and then those prices would be shrinking, okay? And if it reverted back, something started getting jiggy again, these volatility starts rising, the underlying doesn't have to move. Those prices are getting more and more expensive for every 1 percentage point move. And keep in mind, when we're looking over here, this says 0.30, that is, in percentage terms, a 30 percentile. So what I'm talking about, it goes up to 31 here. This turns into a 31. Then all of the prices in the options would increase according to their volatility, okay? So we can tell by just looking at this chart. It doesn't matter if it's XYZ, ABC, Tesla, whatever. As long as we're looking at that underlying implied volatility, we can kind of draw these lines in. Now, a lot of people might focus in on, hey, a 30 is really low. Well, yes, it is really low for Tesla, but it's not necessarily low for XYZ or ABC. So when I'm looking at Tesla, I have to look at Tesla's implied volatility. I don't look at Tesla's implied volatility against Facebook's implied volatility. That's apples to oranges. I need to look at Tesla's implied volatility to determine if Tesla's options are cheap or expensive. Does that make sense to everybody? Smash the like button or comment or something. Let me know you guys are still awake out there for me. All right. So this is going to be the key to determining your option strategy. This chart will determine whether or not you are looking to buy or sell. Now, if I stretch this out to 3 years, the same underlying that we were just looking at, you can see that even over the last 3 years, this boundary has held pretty well. Yeah, before the pandemic, our volatility was overall a lot lower than it is here. So we've kind of incrementally just notched up a little bit across the board in every underlying. But you could draw these out a few years back and still see that they are wanting to stay within the range. Now, I like to have mine pierce just a little bit outside of my boundaries so that I have more opportunity. The other thing is I want it to be a little bit tighter. I don't mind if it goes out and rolls back in. That's what I'm looking for. If you guys want to go a little bit further out and have less of the touches happening, then you're getting up close to that. It will limit more of your opportunities, but you will be in on the ones that work out probably more often. I'm not worried about it going a couple of percentage points against me. But we can continue to look through this. I don't know why I have that one up again. But again, what I was trying to do here is that volatility for this underlying is starting to look like it wants to remain up at this upper level. So we might have to start looking at, for this underlying, a new coefficient, just a slightly higher, a notched higher area of interest for the volatility there. The other thing is, let's go back to this. We can continuously look at this and remember that, see, this is another underlying completely different from the last one. We saw that the high of that one was kind of around 40. This is why I don't want you to compare apples to oranges, because look at this one's implied volatility. It gets down just below 5 and starts moving higher. So we cannot necessarily look at this one where the high here is somewhere around 45, maybe piercing into the 5.0s here that one time there. So we can't compare that one to this one, where this one is showing that, hey, I almost never get below 5.0, right? So a different volatility coefficient for this one. Again, you would have to discern, is this high or low? What I like to do is draw a line around the outsides and then pick the middle line. That tells me sell zones above, buy zones below. All right. So here, this is starting to rise off of that low area. I think it's a buy zone. Why? Because you're buying cheap. And if I do expect volatility, or if I'm lucky enough to have volatility start to rise here, and I bought that option, right, off of this low here, then I can see that it wants to go back up to this area. So that is what I'm looking for. All right. So I'm not even talking about my directional assumption with the underlying. I'm just talking about, if I had an idea about this underlying, I know that because the volatility is so low, whatever strategy I'm doing, I'm going to be doing it probably for a debit. Okay. Means I'm going to be buying it because I know I'm buying cheap, right? I would not want to be selling it when it's that cheap and volatility starts rising, right? Because if I sell it and volatility goes up, every 1 percentage point increase, the premiums in the options are increasing. Okay, every 1 percentage point. So what I'm trying to get at, folks, is volatility is actually what drives the options pricing. It's not the underlying moving higher and lower. That's not driving the options pricing per se. Delta is moving around. Yes, the pricing is going to adjust off the fluctuations of that underlying, but volatility here is the thing that can actually counteract any directional move whatsoever. Okay? And I'll show you how that works out. As a matter of fact, I'm talking about it right now. Let's just take a stab at it real quick. Make sure I got my pen up. So let's talk about this. We talk about the options and volatility. If volatility increases, right? And let's just say vol increases and the underlying XYZ, let's just say the price of XYZ starts going down, right? We've seen this, the underlying go down. As a matter of fact, back in the pandemic, actually even before that, the first time I ever saw it happen was basically the dot-com crisis, where the market free fell and people that owned calls, because volatility exploded so much, where long calls were making money on the market free falling. Because of that volatility explosion, those calls were making money. So you will see that happen. So it's not beholden to the directional assumption. What is going to drive price more often than anything, positively or negatively, is the volatility. So what I'm trying to nail down here is the fact that while our directional assumption does really impact our profitability, what's going to impact it probably even more is the volatility. So if we can set up these strategies according to whether they're cheap or expensive, what I'm trying to drive home here is that if those prices go higher, we could be directionally wrong if we had bought it and still make money, and vice versa. If I had sold options when they were super expensive, let's say I sold calls and the market continues to drive higher, well, if volatility comes out of those underlyings, I could see profitability very quickly, because that volatility downticking is going to offset any positive increase from the delta of the underlyings. Okay. And I'm going to talk about those. I'll talk about those in a minute here. So thank you, Dominic. Appreciate the kind words. So if you don't know which direction volatility is going to go, though, then, a lot of times we have stuff where volatility is middle of the road or maybe kind of moving into another paradigm, right? If I'm looking at GLD here, I've got a bullish market assumption based on what I see happening in gold. And this isn't the updated gold. Let me see if I can find a gold chart from today. It popped a little bit. Thought I would have one. How do I not have one ready? Anyway, so continuing to trudge along this trend channel here, I've talked about the all-time high from previously, the 1923 here. So I've got a bullish market assumption here. I think that we're going to see some more inflation. So I'm just talking about playing this to the upside using GLD though. All right. So I've got a bullish assumption in here. Now, if I look at this volatility, you can see the volatility has really kind of exploded in here. So I don't know if we're going to see this volatility come out, because a lot of times when gold rallies, it's kind of different from everything else, where when gold goes higher, we a lot of times see option prices or volatility go higher with a bullish move in gold. It happens on the bearish moves in gold too, but we still more often see it in gold than anywhere else. So with that said, where am I in relation to volatility? I would say historically it seems pretty high, but I'm worried about this volatility creeping back up, especially if I start seeing this market start pushing above this Fibonacci, because that's going to start getting the shorts really on their heels. So volatility could go higher, could go lower. So in some cases, what we want to do is isolate volatility. We want to make sure volatility is not impacting us. So I'm going to show you how we can play around with that with this strategy here. We can basically offset it. All right. And didn't want to change for me. All right. So let's talk about this real quick. I've gotten into it a little bit here. One of the things I want to talk about here is those Greeks, and then finish up with a couple other things. But I want to talk about this real quick. Delta. All right. Delta is data. All right. Actually, a lot of people will just say that delta is the rate of change. Okay. So it's the rate of change to my options premiums. So, and it's based on a $1 move. All options are based on a move higher. Okay. And in this case, it's a dollar move, or an advancement, if you will. So this is based on a dollar move. So if this says if XYZ goes up by $1, then my options increase on the calls. My call options go up. All right. Put options go down because they're getting further away. But it's based on a dollar move higher, and the calls of the option will move up equivalent to what that delta is. All right. So like right at the money, they're usually about a 0.50 delta, okay, or 50-50, meaning they can go up or down 50. It's 50% chance. And then gamma is also based on an advancement, but it's based on the dollar number 2. Okay, so dollar number 2. This is going to usually have like about a 5 cent, let's say, right there at the money. And gamma just goes with delta. It goes with delta on the second dollar. So first dollar, that first dollar, our options increase by 50 cents, right? On dollar number 2, our options increase, gamma goes with delta, 55 cents. Okay. So gamma on that second dollar goes with delta, and my options would then increase by 55 cents. 50 cents on the first one, gamma goes with delta on the second, 55 on that second dollar. That makes sense for everybody so far? Folks, if you have a light bulb moment, let me know by smashing that like button. All right. Gamma delta, thief, the thief in the night, right? Most people don't call it this, but that's theta. Theta is the thief in the night. It's always negative, right? It's always negative. Why? Because you can't go back in time, folks. Options are expected to expire basically with no theta or worthless. In the money options will be at their value, if you will. And I can talk about that here in a minute. But all of the theta, all of the extrinsic value will go out. So theta, while it's the thief in the night, he steals your premiums, right? And he gets more and more aggressive the closer he gets to expiration. So if this is let's just say 100 days to expiration out here, we could see theta kind of do this. And basically 7 days to expiration here, we got about 35 days. And 35 days to expiration is really, this is our sell zone. And this would be outside of 70 days is our buy zone. All right. Why? Because theta is more aggressive the closer we get to expiration. He starts out, 300 days out. He's only taking a penny at a crack. And then it gets to about 100 days. He might be taking about 2 pennies. And he gets about 70 days, maybe taking 2.5 pennies. Okay. But inside of 35 days, he's probably taking a nickel. Inside of 20 or 7 days, he's probably taking 25 cents, 50 cents. He's just taking fistfuls of money out of your pocket. Okay. So that's why I want to get inside of 35 days to expiration to sell. Or if I'm thinking volatility is extremely high and I have to sell, where am I going to sell? Inside of 35 days or right around that. I'll go outside of 45 days if I'm in there. 45 days and in really 35 days is the sweet spot. All right. 70 days to expire, just outside of 70 days to expiration, sweet spot for buying. All right. Doesn't mean you can't go further out. It just means that theta is going to be less aggressive further out. So the sell zone inside of 35 days to expiration, buy zone outside of 70 days to expiration. All right. Limit the theta decay when we're buying, and volatility. Vega is just volatility. It's implied volatility. All right. And Vega is based on, we've talked about this, right? A 1 percentage point increase. All right. So Vega is just implied volatility. You see implied volatility all over the place in the trading platforms. Not so much Vega. It's only over there in the option montage. It's just a fancy way of saying, volatility, the thief, right? Goes with gamma, goes with delta, all right? Those are easier ways to remember those. So theta being always negative, we can take advantage of that by selling and let that guy take fistfuls from us, right? If we're buying, we want to kind of keep that guy at bay. So go way out in time and limit that guy, all right? If you're buying. All right. But you don't have to worry about those Greeks so much. All right. Let's go over here to the option montage and talk about some real life examples, give you guys a little bit better idea. So when we're talking about 15 days to expiration here, we've got the calls on this side. You can see all of our Greeks, right? Gamma, delta, theta, vega, and on the put side. I'm going to stick to the call side because we're pretty much sticking with the calls today. So we can look at delta, and remember, this is the underlying I'm talking about. Increases by $1. If we were to go up by $1 here, then these premiums would affect the delta would then go into those premiums just on $1 move higher. So it goes from 180 to 181. We've increased by $1. We would see the premiums increase by that 65 cents. At the monies would increase by the 50 cents. All right. That's what we were talking about with the at the monies. Then on dollar number two, we got dollar number two, we get gamma goes with delta on the dollar or second dollar. So now we would have 68 cents going into those premiums on that second dollar move. All right. First dollar move got the 63 cents. The second dollar move got 68 cents. All right. Or a total of $1.28 over the $2 move. All right. And you can see it all adjusts a little bit less gamma. Gamma gets ramped up the closer and closer we get to expiration. So you hear folks talking about gamma trading. Folks, they're just really talking about short duration options that they're trading, and they have a bullish assumption. So they're just trying to get that extra boost off of quick moves like intraday moves, maybe a 1 or 2 day move, okay? Not longer duration moves, all right? Those guys are not trading gamma on longer durations. They're just trying to get the quick hits, all right? And then we see theta across the board negative, across the board on this side negative, because you can't go back in time. One thing you can notice here, look at theta from 100 days to 79 days. You come in 30 some days, theta didn't really move at all. He didn't even notice you're still there. He's just kind of taking his teething or whatever. And then basically you go in 30 days from 70. That's why I was saying go outside of 70, because this is where we start seeing the theta start to pick up a little momentum. And then you could see if you got involved from 51 days and in, theta has doubled. So you can see that it's not binary, all right? It's not like linear. It ramps up. It really starts getting more and more aggressive there. And then Vega, this is the one I want you guys to really think about. Vega, it increases and decreases more further out in time, all right? So volatility will affect further duration options more. Now, if you have like a binary event or an earnings, that can jack up the volatility in that month. So sometimes what we can do with this is take advantage of some of that skew in the fronts, right? If there's a earnings or something like that, or there's higher volatility closer to expiration than further out, well, why wouldn't we buy way out there, expect volatility to rise or volatility coming out in the ones that I sold that were really expensive, right? So we can see that out here, let's just say any one of these, you could see that a 1 percentage point increase, if we're just talking 1% increase here and a $1 move, we could see how these would almost offset in some regards, right? If I had 2 percentage point move in volatility and a $1 move in the underlying, you could see how, especially if it was a negative move in the underlying. If the underlying started going down and my volatility went up, well, that would offset that pricing adjustment, right? If volatility went up by 2 percentage points, that's 66 cents going into the premiums. And if my underlying went down by $1, it's only 52 cents coming out, right? Something to note with this. We were talking about this all being an advancement, right? Think about it is a simple concept. If it was to go the other way, the underlying goes down by $1, then you have to add that negative. Negative plus a positive makes that a negative, right? Or over here, a negative plus a negative equals a positive to the position, right? So if the underlying started going this way or down, then we would be able to see our premiums start to increase, right? Because a negative move plus a negative delta makes that a positive to the position, right? Same thing if you sold options. Well, theta becomes a positive to your position, right? I sold options, so that's a positive to my position. Make sense? And you can take advantage of that. So let's start building this out. Now, if you guys have probably heard me, if you guys watched any of my older videos, you guys know I do not like or love buying in the money options. Why? Because I feel like the risk reward is a little bit skewed here. I like the out of the money options and buy a couple of extra rather than a one in the money option. And I explain those things on the long calls strategies. But with this one, I want it to act like the underlying does if I had a covered call on it and limited risk. Really, it's a strangle. But this was the easiest way to call out a strategy on the floor. Poor man's covered call. And everybody knew they were looking around the 16 delta, or the 84 delta, which was in the money, somewhere in the 80s. So when we're looking at doing these in the money options, I want to go further out in time, right? Because I want to limit that theta decay. I'm going to go in the money just around these 80-ish deltas, okay? Because what that tells me is for every dollar move higher, if I'm directionally correct, my premiums will increase by that 80 some odd cents, right? It's going to increase by those 80 some odd cents there. So I want to take advantage of that, but I also want limited risk to the downside. And like why we call this a poor man's covered call is because we're doing the covered call strategy over this in the money option. But the beauty about this in the money option is I have zero risk below my strike, right? Zero risk if the underlying goes below whatever strike I pick, okay? Because if I'm buying an option, I have the right but not the obligation to offset the contract, all right? Which means if I buy a call, it means I can say, I want your calls at my price level, which would be whatever strike I'm at. So when the underlying moves higher, I make gains in my portfolio for that. But if the underlying fell out of bed, I have no risk below my strike because I do not have to then buy that stock at that strike price. That's better than if you own the stock and it went down, right? Because if the stock goes down, then you can have risk all the way to zero. And you're limiting your upside potential with the covered call. This, we have upside potential limited, but we also have downside limited as well. With this one, though, if we went out there and just bought the call, I'd have to pay $17.50 for that. You add that $17.50 to this, $17.50, basically I get $182.50, right? $182.50 is my break even. So I have to go pretty high in order to get to that point. So much higher than where I'd be buying this. So what I want to do is try to buy this strike, the 165 strike, and I only picked the 165 strike to make math easy here, guys. 165 strike, I want to buy. All right, so I have no risk below 80. That's good. I know I'm paying about $17.50. Now, I want to buy this strike for what it's worth, which means the 65 strike is only worth the difference between these two. All right, or let's just call it right in 179. Let's just say 179. Let's call it 180, just for math again. So let's say we're right at 180. These would have to be worth from 65 to 180 around $15, right? It's a little less than that because we can see we're about $1 lower, maybe $14. which means that there's extrinsic value in there. What we like to do is just kind of do a little bit of a cheat. It's not perfect, but this is the extrinsic value of these options. The corresponding option kind of gives you a hint as to how much. I see your question out there, Sissel. Give me 1 second. So it gives us a little bit of a cheat as to what the extrinsic value is, right? It's about $1.65 that I have to worry about on that extrinsic value. So that's where I want to try and sell an option. If I sell a call, that covered call, for around that $1.56 at the nearer duration options, right? Then I've paid off all the extrinsic value of my 65 calls, right? So now if I've paid off all the extrinsic value of my calls, I've offset volatility, right? I've offset the theta, all right? Those extras that are added in that will go away through erosion, volatility coming out, all right? So if I sell something to pay that off, then I actually am a retainer of value at the pricing right here. So I would try to get my pricing somewhere between the bid and the offer. So somewhere around 179. So really I'd want to have this, a little bit lower, 1490 or something. All right, so I'll get to those. Concern about large, wide bid offer spread on the long call, January 24 being some $2 to $4 wide question. So that is a great question. Further out in time, that's one of the struggles with trading options, especially further out. If you go out 200 days, they're like $1 or $2 wide, right? The beauty in this strategy and like the synthetic long is we are going to price it in to be right where this underlying is trading. We know that after we build this out, that we should be somewhere in that trading range. And with this strategy, a lot of times, like with the synthetic long, synthetic short, we can actually build this strategy out to where we are buying the underlying lower synthetically in a sense, because we've paid off so much of this debit that we've got it a price level that was unachievable in the open market. Okay. And I'll show you that here also. And number two, how and when do you adjust the long call when the stock drops considerably? How and when would you adjust for the guidelines? Great question. Sissel is all over this stuff. It's like I almost plugged these questions. I didn't plug these questions, but they're great questions. So if the underlying comes off, right, and you still are bullish, then I would look to cover my calls, my short calls, and then on any type of bounce, start layering them in. Now, you don't want to lock in a loss, meaning when you get involved in this underlying, you don't want to keep selling calls all the way down to like 160 if it keeps going down, because then you're locking in your loss in a sense. So I would chase it only down to where my break even is to try and sell some calls on that. All right. Does that make sense? Did I answer your question, Sissel? I think I got them. So what I would do is be selling those calls and adjusting. If the market goes higher and I got out of my calls, I would still adjust those again higher and higher and higher. And I look to sell the 16 delta on my covered call strategies, my synthetic longs, any of these types of strategies where I'm looking at a covered call, I'm looking somewhere at around that 16-ish delta is really the sweet spot for me. Obviously, with this strategy, I wasn't able to get to there to pay it off, right? I mean, I probably would have had to go deeper in the money to do that, but I wanted to make this math a little bit easier. So we bought these 65 calls, right, for $17.50. I looked over here. I'm just looking at these over here, right? Give me an idea what's happening at these levels. That's the extrinsic value. I just go over here, try and find the nearer duration, that one that is in that sell zone. Yeah, I'm a little bit further out at that 45 days, right? But it's pretty darn close. And I got the volatility where I want. The volatility is pretty equal, right? So buying these and selling a call here. This premium pays off the extrinsic value of my calls. Okay? That makes sense? And look, I dropped it down to 1570. You add that 1570 into the 165s, and I'm a little bit high on this, but this was also last night when it was trading a little bit higher, I think, on the close. But you could see that I'd be in at 180.77 here. Now, Sissel was asking, when they're really wide, here I'm paying 77 cents over or dollar over. So what I would do with this strategy is I would probably ratchet this down to the pricing that makes it very equivalent to where we are trading. Okay, I would not pay a dollar over on that example. Was something that I did not notice when I was building this out. I was looking at this number right here probably and thinking it was closer to that when the options closed kind of thing. So I'm not too upset about being 10 cents over or something, but a full dollar over, I would play around with the pricing to make sure that it was equivalent to what's happening in the markets. Does that answer your question there, Sissel? All right, so that's how we want to do it. If we can pay off that extrinsic value, I want to make sure that the pricing ends up being somewhere in between those two underlyings. And with that, here is what our defined risk strategy looks like. And the reason why it slopes and is a little wanky here is because we have two different months, folks. Think about this. If I were to let this trade work out like Sissel was talking about, and I let these covered calls right here expire worthless and come off, then I just own this long call and I can continue to make money on the upside from the long call. All right. And then it kind of arches in a sense on the downside because volatility plays a major role in this, right? If I own this long call and even if the underlying is coming down, it's really based on volatility. Volatility starts increasing. I can see these premiums go up, right? So, matter of fact, let me see if I can, yeah, I don't have it up. So it's hard to discern the break evens and everything else on this, but what we want to do is let this covered call come off and look to roll out in time and higher around that 16 delta, try and collect another dollar or so, lower that overall cost basis. John David saying, aren't you just doing a diagonal? Yes and no. It is considered a diagonal. As a matter of fact, I think they call it a diagonal. They aren't going to call it a poor man's covered put or a covered call. And the reason why is because it really is a diagonal. But I look at diagonals a little bit differently and set them up a little bit differently than I do with the poor man's covered call. So while this is a quote unquote diagonal, just like we see butterflies kind of come up as different things as well, that they're a butterfly when they're not really a butterfly. They just give a broad brushing stroke. The reason why it's a diagonal, I'm buying a further duration, selling a near duration at different strikes, right? Calendars are the same strikes. So while, yes, it is considered a diagonal, my rules for a diagonal are a little bit different. And this is why on the floor we would name things differently, right? A broken wing butterfly or an iron condor, all of those things. So people triggered in their head exactly what we were talking about, right? If I said a poor man's covered call to somebody, then they immediately knew I was talking about in the money options on the longer duration and shorter duration options have this short, okay? So that would be an immediate trigger. Poor man's covered means that that's an in the money option and an out of the money option. A diagonal would usually mean that it was an out, like an at the money or out of the money and then a near duration option. Does that make sense? Not same strikes, still different strikes, but the major difference in a trader's head when there's just all kinds of noise going on, rather than saying, hey, I need the May, July, 165, 195 call diagonal. No, they just say, hey, I need the May, June or May, July 65, 95. Actually, they wouldn't even say that. They just say, I want the May, July poor man's covered call. And then I would immediately know I needed to be looking at the in the monies as opposed to the out of monies. Does that make sense? So while the nuances are very similar in nature, where we're buying one, selling another, different strikes, those rules are the same. The difference here with a poor man's covered call is the call we're buying is in the money. All right. One of the few times I do the in the monies is with this diagonal, which is a poor man's covered call. Now, if I were to go out there and buy this stock at $180, do the covered calls, lower my overall cost basis on it, I'd have to put up about what's this trading about 165. So let's just say it's trading around 180. I'd have to put up half of that. So we're talking $9,000, almost $10,000 I'd have to put up. Well, much less with the options. I'm only going to, because I'm buying that in the money option, I only have to pay the debit. So much less, because I have no risk to the downside below my strike. I have a limited risk to the downside. So I've got that covered. I've got a put in there, right? There's a synthetic long put in this strategy, if you will, because I don't have any risk below that strike. If I had the stock, I'd have to have that put to limit my risk below that stock. All right. So we would say it was a poor man's covered call. Really, it's a poor man's stock with a strangle. Okay, is really or a collar is what it is. So actually, it's a collar, not a strangle. So anyway, $1,500, much less money than you'd have to put up if you went out there and bought that stock. So a win-win there. So the in the money long call makes the difference. Yes, the in the money long call is what you're actually banking on for the incremental increases. And you can see when you're doing this strategy would be much less than if you went out there, bought the stock and did a covered call, or even bought the stock and put on a collar. All right. So either way, those would work out. Anybody else have any other questions? You guys should take advantage of this. It's almost, they're telling me we don't have much room. And I was going to switch the offer today, but I'm going to throw it out there because there is a couple of spots left in there. So you guys should take advantage of this. You guys get everything I've ever done, and you have unlimited access to me. Reach out to me if you have any questions on your strategies, portfolio, any of that stuff. I can't give investment advice. All I can do is tell you what I would do, which is probably the prudent thing to do. Anyway, upgrade that. You also, like I said, can check off any video you've ever watched. And the best part is you can chat with me. I'll be your mentor. Thank you guys all for joining us. I do appreciate all your kind words and you guys sticking around through this. I will circle back around for some of you folks that are late to the game, watching this a little bit later, maybe after work. If you have any questions, comments, or anything else, I will reach out and comment back to you there. Don't forget to please smash that like button for me. You know, you aren't limited to those. And don't forget to subscribe, because I do off the cuff videos in the morning. I don't know when they're going to be out, but hit the bell and you'll find out. If you can't take that wasn't a very good one. Can't take that? Take it easy. Did you say the poor man's covered call is a strangle? No, I did say that, and I meant to say otherwise. What I meant was the poor man's covered call is really like the stock with a collar. And a collar is when you own a stock. Basically, it was made famous by Mark Cuban when he did it with the Yahoo stock. If you guys remember when he sold whatever broadband or whatever the company was that he sold to Yahoo, well, he got almost all stock for that sale. And what he did was then went to the open markets and put on a collar, which is covered calls with a long put. So he used the short calls to buy his long puts. And what that did was locked him into a range, right? It can't go, if it goes any higher, he gets called away. If it goes any lower, they get, he gets to put them to him, right? Because I'm long puts, I get to say, hey, they're yours. One of the things with when you're doing these kind of deals is they'll put you in a lockup time frame. Like you can't do anything for so many months or whatever. So if the stock would have gone higher and somebody called him away, well, he didn't initiate that. So then it would have gotten him through the red tape. And if it would have gone down, which it did, then basically he made a killing because he could get out at that stock price. Now, he couldn't get out at the stock price. He just got out of the puts that, made up for that difference. Okay, the stock went free falling. He basically sold it at the all-time high. As a matter of fact, folks on the floor when he was doing this trade was like, he didn't know what he was doing because he was giving up so much edge. A lot of these guys didn't even go out there and short the stock to offset their strategy because it was so good that they didn't think they needed a hedge. Well, next couple of days and years, we saw that was the quintessential high. Not many people get to say they sold the high. Cuban pretty much sold the high on Yahoo by doing that collar. All right, does that make more sense then? Poor man's covered put or poor man's covered call. We're doing the poor man's covered put next week, which is a synthetic short with limited risk. And poor man's covered call, this is like the stock, but I throw a collar in there, which is short call, long put. That's why I said we don't have any risk below that strike. We don't have any risk below that strike because as the buyer, I don't have to do anything, right? I don't have to say I want that stock. I'll just say I'll let it expire worthless and lose that money there. Does that make sense? But you can't lose any more than that. Can you please help with our drop in stock as to when and how to adjust the long call or the leap? Do you use the delta as the guide? I do, Sissel. So that's a great question. Sissel's all over this today. You should be in all my classes and just throw out all these questions every time because they're great ones. If the underlying comes down, I am going to sell calls. I will roll out of those higher calls and roll them down. I'm going to go only to where I'm not locking in a loss. All right. So if it goes below, I won't sell below a 179 call, if you will. Now, if I've sold my, if I've done this for a year and I've lowered my cost basis by $10, well, then that's where my break even is. So that's where I'll go to. Does that make sense? But I'm not going to go below really to lock in a loss. That's my personal opinion. Some people might do that. I like to go to about where it's at, let it ride, especially if I'm still bullish. Now, if your assumption with this underlying changes, by all means, pull the ripcord on this trade. And I don't care if it's still profitable. Pull the ripcord on it. Get out of it. All right. Anytime your gut feeling tells you should get out of it, you should listen to that gut. That's great advice, folks. Never talk yourself out of going against your gut. All right. So you're saying you can add, you don't need to add the long put to this strategy. John's asking, do I need to add a long put? No, because that long call, I have no risk below that, right? Because remember, when you buy a call, you, as the buyer, have the right but not the obligation to offset the contract, which would mean as the call buyer, I have the right but not the obligation to buy the underlying at that strike, right? So I can get that stock. I can just tell that guy, I want the stock right now at 165. But I can also say, I don't want it because it's trading at 150. I don't want to buy it at 165. I'm out. I'm just going to let that option expire. I'm just going to let it go, right? So I don't need anything for that. If you are long stock and you want this type of limited risk, then yes, the collar, you would need to shoot for like those 16 deltas, what I usually do. Okay. All right, everybody good there? You guys, before you go, smash the like for me. You guys had a light bulb moment. It helps out, feeds these bots that run out and find people like you to share this with. And I do spotting the trades where I'm talking about the markets in the live, talking about what's going on, giving risk assessments, talking about the trades that I do. That you'll need to subscribe to right next to the bell there. The bell will tell you when I pop in unannounced. In those spotting the trades, I am unannounced. Yeah, we put it out there. Hey, it's going to be somewhere around 11. Well, it's somewhere between 11 a.m. and 6 a.m. Really. You hold webinar sessions on a regular basis, just on the poor man's covered call strategy only? No. As a matter of fact, I do these every Thursday. Next Thursday, we're moving it off to 7 o'clock Eastern and 4 o'clock Pacific. All right. Try and get it to where it's a little bit easier for some of you folks that are still at work. All right. To be able to take advantage of this. So every Thursday, webinars on different strategies, just like this. I'll break it down and into the minutia for when, where, and why you would need these underlyings in your portfolio, why you would set it up this way, and when you wouldn't want to. And then during the week, every day during the week, in the mornings, I do spotting the trades, which that's the ones I pop in and unannounced, and that's the bell one. Right? That answer your question? So no, I'm in here almost every day, right, for you folks. And if you guys take advantage of this, I'm in here 24/7 for you guys. All right? Yeah, it says during hours, but listen, I work 15-hour days. I'm constantly working. So if you hit me up, I'm probably here at the computer, and I'm not going to let that slide. I know people when they have questions, they want them answered, right? So I'm here for you. What's that? Price drops below the 165. Won't it be assigned to you at 165? No, because I'm the buyer, right? I am the buyer. I can say the buyer of an option has the right but not the obligation, which means, so if it goes below 165, I can say, no, I don't want anything about it. Right? So I can just say, no, I don't want it. I don't have to do anything. Right? Now, if my 165 calls, though, are in the money at expiration, right, and I don't do anything, then they're automatically, any in the money options automatically get assigned. Right? So if I'm long and in the money option and I don't say anything, well, in the money means that I want it. All right. All right, so that would be a different situation. You would want to just cover that trade. But if it's below my strike, then I don't have to do anything because I, as the buyer, I paid money for the right and not the obligation. When you're a seller, you have the obligation. You have nothing to say about it because I collected money. I gave away my rights. Okay? That's how it works. If you're a buyer, you're buying the right. If you're a seller, you're giving up that right. Okay? So only the seller can get out of the trade. But if somebody says, hey, they're yours, well, they're mine. Okay? But the buyer can say, no mas. I want nothing to do with it. Even if it's in the money. Which would never happen. I've never seen that. All right. That's all I got for you guys then. I'll see you guys tomorrow in the spotting the trades, or see you next week on the poor man's covered put. Don't forget to hit the like button if you had that light bulb moment. Can't take that? Take it easy. Bye for now.